There's been a lot of talk about how persistent inflation has shown itself to be. You were pretty early on, at least among Fed members, of saying, don't get too ahead of yourselves and talking about cutting rates. A lot's changed, at least from the data that we've gotten over the last, 3 months or so. Has that changed your view as well about staying where we are?
Well, the second half of 2023 surprised us at how rapidly inflation fell. That was really good news, and the economy remains strong. We all hoped that was going to continue. The first quarter of this year, it seems like it's stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time. I think we're in a good place right now. Labor market is still strong. We can take our time to get more data to see if disinflation is going to continue. And if it does, great. If it doesn't, then we need to take that on board.
What is the complexion right now of disinflation? What actually drove us at least down to the level where we're at right now?
Most of the gains that we saw last year were supply side improvements. Supply chains getting better, Americans coming back to work, a lot more workers entering the labor force. That's really positive. I don't think monetary policy actually brought demand down that much. And so most of the gains were because of the supply side. Now the question is, if monetary policy has to take us the rest of the way there, is it tight enough to do that? I wrote an essay today on our website raising that question, and I'm not sure how tight monetary policy is. We need more data to assess it.
How do we know that the disinflationary process has still some ways to go? Or how do we know that maybe this is it? This is the new normal?
Well, it's not the new normal because it's 3%, and the Fed can and will achieve 2%. The question is, if disinflation is still underway, then maybe it'll continue on its own, and we can then take that on board. If we need to hold rates where they are for an extended period of time to tap the brakes on the economy, or if we even needed to raise, we would do what we need to do to get inflation back down.
I have to just ask you, though, about 2%. And I know why the Fed stands by that 2%. But I talked to people around the room this week here, and their cost of capital, they're basing that more on closer to a 3% rate. And the idea is they're saying, look, the 2% target, that needs to come up. That's not the reality long-term structurally, and at least not for the folks in this room.
Yeah, I disagree with that. Yeah. I mean, I think that ultimately the central bank, whether it's the Fed or the ECB or the Bank of England, can determine whatever the inflation rate is. And over time, if they conduct their policy appropriately, people will come to understand that, will adjust their behavior. We're committed to 2%. We will get to 2%. And we will get an interest rate environment necessary in order to achieve 2%.
You know, one of the arguments, though, Neel, is that the idea of nearshoring, bringing things back home, building chips in America, that's going to create, they're going to be more expensive than if we were building them overseas. And that is going to be, consistent inflationary pressures longer term. There are some macro forces underway. Why not think that it's got to be above 2%
See,
longer term?
I think those trends are real, but those would suggest to me a one-time increase in the price level, not necessarily an ongoing increase of inflation at a higher level. But we believe, and I believe, that the monetary authority can ultimately, long run, determine the inflation in the economy. But the rate environment necessary to achieve that may be different depending on these broader macro forces.
So rate cut this year, should we take it off the table? Is it still a possibility?
It's certainly still a possibility. We need to let the inflation data tell us. I mean, I think my colleagues and I, we all have a range of views on where the economy is going, but we're all committed to letting the data guide us. And if the data comes in a positive manner suggesting disinflation continues, we'll adjust.
Go ahead.
But is it just housing pressure? Like, you write a lot about housing pressure, and we talk about it. We're talking with a lot of people in the real estate sector. There's not enough supply of houses out there, and that's creating inflation on the housing front. Is it just housing pressures that you guys are really focusing on, or that you're focusing on?
I'm focusing on housing, first of all, because it's traditionally the most interest rate sensitive sector of the economy. And if the most interest rate sensitive sector is not showing as much disinflation as I would have thought, for example, new lease rates appear to be climbing back again.
Yeah.
That's surprising to me. Why is that? That makes me wonder, is policy as tight as I would have otherwise assumed? We are seeing some effect of monetary policy on credit card delinquencies, on auto loan delinquencies, especially for lower credit score borrowers. So it is having some effect, but it's not having as much effect as I would have guessed by now.
I know we have the benefit of hindsight, but you go back to when the rate hiking cycle effectively paused. Do you think that the Fed should have kept going with hikes, meaning additional hikes?
I don't know. I mean, I think that there are lags in monetary policy, and we saw such rapid disinflation in the second half of last year. I mean, it was a really wonderful scenario. That was real, and that surprised us. And so it's reasonable to say, let's just let that continue. Maybe it'll take us all the way home. It ended up stalling out, at least for a little bit.
Do you feel like you can accurately assess those lags, what those lags are? Because even when you talk about disinflation, you acknowledge yourself, a lot of that is driven by supply side issues and not just monetary policy. How do you assess what the balance is?
Yeah, it's hard.
Yeah.
You know, for example, in the housing market, which we're talking about, we know a lot of Americans refinanced their homes when the mortgage rates were very low. And so they're not feeling the pinch of higher rates because they have not had to refinance. And so that happened. That happened in the late 1970s and early 80s as well. That's part of the lag in the policy process. So we have a lot of data that we look at, and we ultimately have to use judgment to try to put it together.
Speaking of data, growth, we're doing okay. Jay Powell consistently reminds us this is a good thing. We hear it, we feel it here at Milken. Is there the possibility that you don't even have to cut rates at all this year because the economy is strong?
Well, no, you're right. So if inflation moves sideways, and if the labor market continues to be strong and growth continues to be strong, then I would be in the camp of we shouldn't do anything. Just let this play out for an extended period of time. If, on the other hand, we start to see inflation come back down or meaningful weakness in the labor market, then that might say we need to start dialing back. Or if inflation proves to be more entrenched, we could have to go up.
Yeah.
But is the economy, is it strong for everyone?
Well, no, it's of course not. And we know that the way policy works, it slows down parts of the economy, and the lower income workers tend to feel the pain the most. And that's, I mean, I wish that were not the case. It's also frustrating that every time there's a piece of good news, you see Wall Street rally, euphoria returns to Wall Street, and yet there are people who are feeling the pain. So it's definitely uneven how this gets felt.
You did mention, though, if inflation starts to go up, I thought I heard you say we could have to increase the Fed. That's a smart narrative still to have out there, that the Fed could possibly have to raise rates again?
Well, of course. I mean, we are data dependent. We are committed to getting inflation back to our 2% target, and we will do what we need to do. Nobody has taken any rates completely off the table. I think the bar is high. Much more likely we would stay put for an extended period of time, and then we'll see where we are.
How would you actually prepare, though, the markets for that? That's not the kind of thing you just want to go into a meeting and surprise the markets on. I mean, you need a little build-up there.
I agree, but like, there's no shortage of Fed
like
communication.
Right? There is
no shortage of Fed
there isn't,
communication to signal when people's perspectives are changing.
Is that Fed communication, though, do you think it's fair? And by that I mean, is it too much? Because you get so many differing opinions, and in the media it's great, we love it, but I feel like for investors sometimes it feels like, okay, we're getting too many people telling us.
I understand their concerns. Yeah. There are 12 reserve banks. We represent regions of the country. So people across the 6 states that the Minneapolis Fed represents want to hear from us often. I turn down 95% of my speaking invitations that I get. So I go out across the district. I'm usually saying the same thing, but in the spirit of transparency, I live stream it so that I'm not giving any secrets away. And if people want to watch it and cover it, I can't control that. And so it's a balancing act where we want to be transparent to the constituents that we represent, and yet we also want to show that we're not giving secrets away.
President Kashkari, I feel like there is more clarity of thought about what the Fed may do next, certainly here at Milken this year around. But having talked to you, we could cut rates, we could raise rates, you're data dependent, I get it. Do you at the Fed and the FOMC feel like there is more clarity about kind of where we are in the economy and where the trouble spots are?
Well, I think there's more clarity on our reaction function, which is we are all committed to watching the data. Our models have not worked very well in the last few years, so we have to watch the actual inflation data. That will guide us. We all agree on that. Now, whether inflation goes sideways or continues to fall, we have a range of perspectives on that. That's where the deviations lie. But our commitment to doing what we need to do, there's no deviation around the table on that.
Are you still paying a lot of attention to financial markets and how they're reacting to things?
Absolutely. I mean, it is a channel through which monetary policy affects the real economy.
Yeah.
And when, it took 3 negative inflation prints in a row, markets started to take that on board, and then one positive job report, and euphoria returns.